In this video, I want to talk about how you can boost your account from 20% a year to 51% a year, which is my own average, and we'll break down every single thing. My name is Eli. I'm a professional option trader. I manage over $8.7 million. And if you're interested in my mentorship, email me and we can see if we are a good fit for one another. Now let's begin with how to achieve 51% per year. Now we will have detailed examples later in the video, but for now, to get a 51% return per year, you need about a 3.5% return per month. So when you compound it, you get about 51% per year. Now you'll be collecting, and again, this is how I do things, but by collecting 6 to 8% of total account capital in credit per position. So it means we have a $100,000 account. We will collect $6,000 to $8,000 in premium per position. This ensures that we have a fixed position size. It's not too small, not too big. And usually, like, my average is 5.6% actually, because sometimes you just cannot collect any more of that. And we'll get to all the juicy numbers in a second. Now I'm buying treasury bills, and this yields about a 0.3% monthly on account, at least for now. If interest rates will go down, it might change. Now the total positions needed to close for a profit is around 12 positions. It's basically one trade a month. So if you have one trade a month and you make about 3% on a trading profit, and you have the T-bills yielding the 0.3%, you'll get to about 51% in a year. Now losses are a part of the game, obviously, and I risk one to make one. So my stop loss is usually 50% of credit, and take profit is the same thing. So with losses, total positions needed is closer to probably 15 positions a year. For myself, I only had 3 losses in the past 3 years, and they were all pretty small losses. So they weren't even the full losses. So take it or leave it. Depending on the year you have, depending on exactly how you trade. But this is will be everything the way I do it exactly. The last thing is you'll need to let fundamentals dictate your position entry and exit. So this is really important. A lot of people don't look at fundamentals at all, which is one of the most important things. And we'll go over exactly how I decide if the fundamentals should dictate to open or close a position. Now, trade small, trade often is definitely a false statement. We are in a very opportunistic business. So you have to jump on very high probability opportunities and not just trade any gunk and that comes your way. The correct way of trading investing is trade moderate size and trade only when the odds are clearly in your favor, and fundamentals can clearly indicate entries, as I just mentioned, and I'll show you exactly how it works. Now, like I said, I work with over $8 million, and it is possible to get 51% return per year with extremely low risk and this kind of capital. This year so far I'm up 27%, but this year has been pretty tough and because of Trump mainly, and all the Middle East conflicts and the trade tariffs conflicts. Now let's go next to strategies, management, position size, and more. So 2 things that I use is short triangles and short puts. For short triangles, I take profits at 25 to 50% of credit. Ideally 50%. I always try to go for 50%, but sometimes things come up and I will change my profit target to 25%. Stop loss is at 50% of credit received, and stop loss orders are only available in interactive brokers, just so you know. Even with that, I usually just close positions for a loss manually. And for triangles, I try to collect up to 8% of my total account in capital, or my total account capital in premium. And this was triangles. For short puts, because this is just basically a directional play, I take profit at the same thing, 25 to 50%. And again, I try to take profit at 50%, but my stop loss can be 50% to 75% of credit. Depends on what's going on. Again, usually I'll keep it at 50% loss because this is much more manageable for me. And given that I do have a pretty good understanding of where price should or should not be moving, I tend to keep my stop loss tighter at 50%. Now for short puts, I will only collect up to 6% of account capital in premium, just because this is a directional play and I want to keep position size a bit smaller here. I will exit position if there's less than 21 days to expiration due to gamma risk. I will exit a position if there are major critical news that moved the price and fundamentals have shifted. I will not roll any options positions. For me, it just doesn't yield a net positive overall, the way I trade at least. And margin requirements need to be up to 30% of account per position. So if we opened one short strangle on gold, for example, this short strangle on gold should not take more than 30% of the total account in margin requirements. That's also a pretty big one. Now, how to find high probability setups, and this is as simple as it gets. It took me years to get to this point where it's simplified like that. And I'm here to show you exactly how I do it. So step number one, I check the CVOL, which is the commodity volatility index, to find relatively high volatility. And we'll go over this exact same process right in just 1 minute, or with real examples, and then I'll also show you my historical trades. Step number two, I will analyze the chart. Is it uptrend, downtrend, or side trend? It should be really, really simple. And step number three, I will analyze the fundamentals of the product. And there's only 3 questions that I have to answer. Is there a fundamental reason for the price to go up? Is there a fundamental reason for the price to go down? And are the news that caused a CVOL increase critical or non-critical? Or basically, are the news critical or not? And you can see here, if we have a yes, no, yes, we're selling short puts. And we have a yes, no, no, it's short puts as well. And we have a no, no, no. It's either a short strangle or short puts. Every other combination is a lower probability setup, and I've done this over 10 years at this point, or so. I've been through a lot of garbage to get to simplify to this point again. And step number 4, I will just look for a good position, short triangle or short put on the broker itself, and see what kind of expiration I get, what kind of credit I get, so on and so forth. Now let's go over a full example, start to finish, how to find a high probability setup, and also what kind of trade we can open. This is how I begin basically every kind of session every day. So I'll just go to the CME CVOL website, and it's just the cmegroup.com, or you can just Google CME Group CVOL, and you'll find exactly what I'm looking at. You'll have to sign up, it's free, and then you can have access to the exact same screen that I do. So first of all, I will go over the volatility. So we'll begin with metals. Go for silver. I always look at a 3-month volatility. So silver is currently, if this is the lowest point, this is the highest point, it's somewhat halfway through. So I wouldn't consider it good volatility as of right now. Now we also have some gold. If we look at gold, it's about the same as silver. It's on the upper half, but I'm looking for something at the upper 60 percentile. And here is obviously not like the ideal volatility for me. So for me, it's not a good volatility. Look at copper, kind of the same thing with copper. We had some good volatility not too long ago, but it's not the case currently. Now let's look at natural gas. So natural gas is actually pretty good volatility if you look at the previous 3 months. The only thing with natural gas currently, we are at the end of October, and I don't trade it from September to March because of the winter months. So it's a no-go for me because things can be really, really volatile with natural gas. But volatility is good though, so that's a good thing. Now we have crude oil. If you look at volatility, clearly it's on the lower side, so we're not interested. Now we can look at wheat, and wheat has a pretty good volatility. Actually, it's pretty high, so that's a good thing. And then we have soybeans, which soybeans obviously also volatility is pretty high, even though it went down. So we have wheat and soybean. So let's see what we have for wheat and for soybean. For soybean, next step is just to see, okay, are we in a side trend? Are we up, downtrend, uptrend? What's going on? So here we are technically still in a side trend. So it's been moving sideways for quite a while, but at the same time, it's closer to the upper range of the price. So, but for us, it's, we'll call it a side trend. Now for wheat, if you look at wheat, wheat basically it's been going all the way down. So for me, it will be a clear downtrend. Now, if it's a downtrend, I really have no way to properly trade it, just because commodities, they explode upwards. And if it's already downtrading, I don't want to obviously sell any strangles on it, but I also don't want to sell any puts, because if the price keeps trending downwards, I'm going to be going against the trend. So in this case, the only thing that's left for us to look at will be soybean. Now, if the price of soybean would have been somewhere in the middle of the range, then this would have been a perfect strangle. But it's not, obviously. The price is all the way to the upper side of the range. So if anything, we might consider some short puts. Now we need to ask the 3 questions. Is there a fundamental reason for the price to go up, to go down, or stay the same? The way I get all the news is I just go to the news section here on TradingView, and you're just gonna go through the news. So we have indicators that China plans to purchase 12 billion metric tons of US soybean this year, along with 25 million tons annually for the next 3 years. Right? So China is one of the biggest single US soybean consumers, and President Xi and Trump just had a meeting as I'm making the recording right now, because China has been absent from buying US soybean. So is there a fundamental reason for the price to go up? Absolutely yes, because China relies on soybean, on exporting soybean, and a lot of it comes from the US. So yeah, there's an absolute reason for the price to go up. And just to be clear, I would probably not enter any short puts with a real account, just because the price seems like it already made the move. But for the sake of example, let's just kind of continue and keep analyzing it. So is there a fundamental reason for the price to go up? Yes. Is there a fundamental reason for the price to go down? Absolutely not, right? If China is going to be buying more, which is what Trump and or the US and China agreed upon, the price has no reason to go down. There's no fundamental reason. It will just go up, especially if they're planning to purchase a lot, right? Now, are the news critical or non-critical? Where these are pretty critical news. They do influence the demand side quite immensely. So news are critical. So we are looking at yes, no, yes, which means we can only really look at short puts. Now, are short puts gonna make money here? Probably 99% chance that they would, right? Even though the price is a bit too extended. So for my liking, I would enter only if I can maybe get a pretty good premium like underneath all this channel, which we'll see in a second. So we have good C-ball, right? That's step number 1. Step number 2, we can clearly see it's in a side trend, but it's on the upper limit. So definitely not a good place to sell a strangle. But at the same time, we have a fundamental reason for the price to go up. There is no fundamental reason for the price to go down, and the news are critical, right? So this all indicates we can only do short puts. Now let's go to the final step and actually find a good position. So if we go to soybeans, and I'm just using a demo interactive brokers account. So we go to soybeans, and ideally I want to look at whatever is closest to 45 days. So let's see, and this is the January expiration. So we are on the correct expiration for the future, January 2026. So ideally, I would probably want to maybe sell the 970 put, and let's see if we can get any reasonable credit at 970, because the price is so far out, but volatility is also pretty good. So this might work out. So let's see. So we go to 970. We are looking at delta 3.8, which is a pretty small delta, and I'm assuming the credit will be pretty small. Yeah, so we're looking only at $56 in credit, which is, it's not enough, right? It's a really, really low credit. And so in this case, what I will try and do, I will try to go to the next expiration potentially, which is, let's see here, 85 days. And see here if we have any liquidity. I don't think we have any liquidity here. So let's go to 113, and we have quite a bit of liquidity at 113 days. And I'm looking at the March expiration now. So let's go to soybeans and open up the March expiration. So here, ideally, I will probably go to 980 maybe. And let's see if we can get any reasonable credit at $980. Let's see here. And we're looking at $181 in credit. So way, way, way better. Now, ideally, again, I want to get a bit more credit. So let's, and this is just how I view things, right? So it doesn't have to be the exact same thing that you would do. So let's see here, we can go to maybe 990, maybe to 1,000, because at the end of the day, the more credit you get, the better your stop loss will be. So if you go to 1,000, for example, let's see here, we get 275, which is pretty respectable. And our 50% loss would probably be at $140, so about 1089, so somewhere over here. So is this a perfect position? Definitely not. I would like less days to expiration. That's one thing. And second thing, I don't want price to be like stretched so much because price can go down. So in real life, I will probably wait for price to go down. If volatility is still high, I will open a position, right? And we are in somewhat of a unique situation because we were all waiting to see how the meeting between US and China will unfold. So this is why the price has been going up. It was anticipating a pretty good meeting, which it was. So it was already kind of priced in. But if China will buy even more soybean, price will go up even higher. So just for the sake of example, let's go for the 1,000 strike. See here, the $1,000 strike. And we're looking at 275. So I would collect up to 6% of my account in credit. Let's say I have a $100,000 account. So I'm looking at potentially, let's go to about 20 contracts. 20 contracts that we should give us. Let's see here, as soon as it loads up. Maybe it won't load up. Let's see here, I'll try it again. But overall, I also want to make sure I don't go over the margin impact of $30,000. So let's see here. So I can collect about 5.3% of my account in credit, and margin impact will be about 27,000. So I can technically go one more contract and still be under the $30,000, maybe even one more. But I will probably just keep it at 20, and it should be quite enough. But here, this is, I guess, the exact kind of perfect numbers that we're looking at, under 30,000 and 6% of credit. And I will just kind of go ahead and open this position. So let me just put it on market. I'll open it as a demo position. And we'll see how it opens up. So it opens up down 3.1% on the position. And this is a market order. That's why if you open it properly, it will probably be opened at about down 1%, right? So let me just put in a marker over here. But this is a position that has a pretty high chance of profiting. But we shall see what's going to happen. But this is the exact process I go to. And again, ideally, I would want price to be lower before entering a position like this, because price is already pretty overstretched and overbought, right? So this is kind of it for the process. Hopefully it was quite useful for you. Now let's go over some of my previous trades this year. And this is my private Discord. We're getting closer to Halloween, so it has a Halloween theme. But I've done 12 trades this year, all profitable. So let's actually look at some of my last position, for example. So this is a crude oil short put. I sold a put at 52, strike 52. This is where the price was when I sold it. So the price has been moving somewhat in a big sideways movement, and we had some risk to the upside. So for the technical, price is moving within a big side trend, and last time price was at $52 level, was at 2021. So this is why I chose the $52 level. Now volatility is somewhat low, but overall moving sideways. So volatility was okay. It was the upper 60 percentile, but volatility was overall moving sideways within this period. Right, fundamentals. So there's lots of uncertainty that can drive the price of crude oil upwards. Ukraine keeps attacking Russian oil infrastructure. We have the Iran-Israel conflict might reignite. Rate cuts will support higher oil prices as the dollar will fall. And there's many reasons for the price to potentially go up and limited reasons for the price to go down. So was there a fundamental reason for the price to go up? Yes. A lot of things, especially Ukraine was heavily attacking Russian oil infrastructure. We had a possible Iran and Israel conflict reignition, and the rate cuts. And was there a fundamental reason for the price to go down? Basically not at that point in time. And are the news critical? Yes, they are very critical. Russia, Ukraine, oil infrastructure, these are pretty critical news. Now, seasonality is something I don't really look at too much, but because it's sometimes it's on points, and a lot of times it's just really false, but I still just gonna take a peek at it. But here in this case, I wanted to roll the entire position if it reaches a loss of 100% of credit, because I was really confident in this position. But usually what would happen if the fundamentals shifted, and I would ask those three exact questions: if the price has a reason to go up, down, and are the news critical? I would do it every single day. And if it changes to a point where it becomes really uncertain, or I get different answers than what I should get, I would close the position, even if it's up a little bit, even if it's down a little bit, because it means that fundamentals have changed. Now, usually when you do this kind of analysis, you're not going to trade much, that's for sure. But at the same time, you will have a very relaxed trading routine, because you know that you're going in when there's an absolutely best probability for you to profit. So this trade ended up being in duration only 18 days, and it was up 50% of credit. What ended up happening is, let me actually show you. I should be able to see it here. So we entered the position right over here when the price was down here. So the price went up immediately down, and then it went up quite strong, and we exited at 50% of profit right on this Friday, September 26th. And this was a lot of Ukraine oil or Ukraine attacking Russian oil infrastructure, was a lot of it. Now, what happened afterwards? So after all that happened, then we had some news of a potential peace deal in between Israel and I forgot the other conflict, but we had some basically news that can ease the tensions in the Middle East. We also had news of OPEC potentially oversupplying the entire market, and these just kept dropping the price down and down. So if I would have been in a position still on this day, I would have exited the position, and I kept the position open on a demo account, and it was still up like 25 or 30% of credit down over here, right? So you would still want to exit because fundamentals have shifted. OPEC is one of the, they basically control the price of oil if they want to. So if they are potentially planning to oversupply, then the price will obviously go down because supply will go up, demand will kind of stay the same. We also had reports that the US government might be shut down on October 1st, which it actually was. And if the government shuts down, by default, there's less energy needs, and crude oil will also go down because demand will go down. So there were a few factors, and then at this point, things were not seen as they were when I just entered the position. And so you have to go through the process every single day and make the decision, right? At the end of the day, it's just a matter of decision making. And if you dial in your decision making, you let fundamentals dictate your entries and exits, you will be making a lot of money really safely and for a very long time, and having a pretty good life. So this is it for this video. If you have any questions, let me know. I will be happy to answer them, and I will catch you in the next one.